everyone, and thanks for joining me. I'm Alan Yates from Peregrine Capital, and welcome back to the Peregrine Capital Hedge Fund Training Academy. So today we're going to be talking about the Hedge Fund Toolkit and what that really means for you as an investor. So if I give you an analogy, a long-only fund is very much like a knife. It's a good utensil. It does what it needs to do, but it doesn't have too many other elements to it. Whereas we like to think of a hedge fund somewhat as the old Swiss Army knife, in that we've got a number of other tools available to us to hopefully manage funds in a manner that provides us with more options and provides you as investors with better risk-adjusted returns. And so today we're going to go through some of those additional tools and just to give you a better idea of what they are, how we use them, and what the implications are in portfolios. So if I think of the toolkit in its broader sense, if you're a long-only fund manager, really your options are somewhat limited in that if you like a company and you think it's going to go up in value, you buy it. If you don't like a company and think either it's going to go down in value or it's not going to go up as much as some of the other holdings in your portfolio, you can either have a lower allocation to that position or none at all. But that's the best you can get, right? And so you are somewhat reliant then on markets trending upwards over time because you need your assets, which you've purchased, to increase in value. And one would expect that if those assets are increasing in value over time, it is partly due to markets increasing as well. Whereas hedge funds have a slightly wider toolkit. And I think the fundamental difference really is our ability to take short positions. And we'll talk through a short example in a second, but everything else outside of that short position is really a derivative of, in some shape or form, the ability to short shares. And that really is the big differentiator between the two. Long-only funds, as the name suggests, can only go long a position. Hedge funds can take short positions. So let's dive into what that means. So if I give you a short example, short really, all it is it means that we are taking a view that we think a company is overvalued and that the share price is going to decline. And in order to be able to benefit from that view, we short that share. And what that means is we borrow it from a long holder, sell it in the market at the market price, and hope for the thesis to play out and be able to buy that share back at a lower price, returning it to the person we borrowed it from in the beginning and banking the profit for our investors. Now, there might be many reasons to short a stock. You might think that there is significant pricing pressure from competitors, or they've got cash flow constraints. They might have way too much debt on a balance sheet, or alternatively, it might just be an outright fraud of a business, like Steinhoff as an example. There are many reasons why a fund manager might short the position, but really the intent of the short is the same every time, and that is to benefit from the fall in the share price. Now, truthfully be told, at Peregrine Capital, we tend to do this in a really relatively small portion of our book. So we use the short ability, the tool, in a slightly different manner. And that mainly is pair trades. So when talking about pair trades, let me give you the example here, is to say it's taking the view on two businesses performing differently, normally within the same sector. So as an example, if we had two shares or two companies performing in the retail sector. So they're both exposed to the South African consumer. They're both exposed to the same input price variables. Macros are very similar in the way they affect these businesses. But it's a question of how they deal with that situation and how they as a business can perform in an environment like the one they're in currently. And so following on that example, let's say that one of these retailers we think has an astute management team. They're performing very well. They're bringing good product to market, et cetera, and therefore we think they're going to do relatively better than their competitor. We can express that view in our funds without taking any exposure to the overall market. And the way you do that is obviously you purchase the share that you like, you short the share that you don't, and by doing that in some degree of equal weighting, you don't have any actual exposure to the retail sector. So if you think that, let's say, inflation is higher than expected and that has a negative impact on retail, your long position might fall a bit, but your short position is also going to fall to some degree, and you are protected in the way that you're managing that position. And so for us, it's a really great tool because it allows us to try and picks stock select at a very basic level that says if we think one company is going to outperform another, we can benefit from that differential in share price without having to take a view on the overall market. And it's a powerful alpha generator in a hedge fund because it allows you to add profit to a portfolio without taking exposure and not being dependent on the market increasing in value. Another way that we can use the short tool in a slightly different fashion is something called a rump trade. Now, a rump trade, and I'll give you the example of Rand Merchant Investment Holdings, which was a holding company listed on the JSE, and inside that company was essentially three assets: Discovery, Momentum Metropolitan, and Outsurance. Now, for us, we'd covered these businesses for a very long period of time, and we felt that the best asset in that stable was the Outsurance asset. But Outsurance wasn't a listed vehicle or a listed company in its own right. And so as a hedge fund manager, we were able to take a view that said, we like Outsurance, we want to be exposed to Outsurance in our portfolios because we think it's going to do very well as a business, but the only way to access that is through RMI. So if you're a long-only manager, your best bet is to say, I'll buy RMI, even if I don't like Discovery or Momentum Metropolitan, I'll buy RMI as that's the only route to market for me to get exposure to Outsurance. For us, we could buy the RMI position and then short out the exposure to Discovery and Momentum so that we just had see-through exposure to only the Outsurance asset, which, and if you look at this chart coming up on the next slide, it'll show you that what we did here is so the first circle on the left is us implementing that view. And then what happened is, if you see up on the sort of far right-hand side, at some point in the future, in kind of, it was April of 2022, RMI actually disinvested from Outsurance, so they unbundled it to shareholders. And at that time, a long-only manager could, for the first time, get exposure just to Outsurance. But you can see here that the share price of this rump portion, which we've carved out into this graph, had already almost doubled in price by the time that happened. So for us, we could get in earlier than our long-only competitors, we could get the exposure we wanted, and we could benefit for our investors in that way. So another tool in the toolbox of hedge fund managers are options, and specifically put options. So the best way I like to describe a put option is it's really like an insurance policy. So you'd buy insurance on your car per se. You pay away some monthly premium to your insurer, and if you have an accident, they will cover you for those damages. A put option is very similar for a portfolio or for a fund manager. So we pay away a premium normally to a bank for protection against the potential that an index falls or that the markets drop to a particular level. And the lovely thing about put options for us is it means that we can protect the portfolio without having to disinvest from the shares we like. And put options are super valuable when markets really do fall in a heap. So it's something that we will have in the portfolios almost throughout the cycle because you never know when the next major issue is coming. But particularly when around times where there's a lot of volatility or heightened uncertainty in the market. So the example I've got here for you is COVID. So we bought put options in February of 2020 to protect the portfolio from the potential that COVID became something of a global pandemic, which obviously at the time was not priced into markets, but was what came to pass. And so we were able to buy these options pretty cheaply and protect the portfolios really well when COVID started to spread outside of China in that period of time. And what you'll see here is in that chart, in that month of March through to the start of April, the index was down like 17% for the month, and that option only cost us less than 1%. So by paying the 1% premium up front, we'd managed to protect our investors against that big market drop. And that's a huge benefit for investors because obviously, first of all, it means that you're not participating in the market drawdown. So your volatility is significantly lower than if you were in an equity fund at the time, as an example. And the second benefit is for us as managers. It means that we can engage the market on the front foot in times like this. So when there's lots of volatility, lots of uncertainty, that's often when there's big price dislocations between the value of an asset and the price that it's tradable at. And so we could exploit those opportunities, we could engage the market, engage in that risk because we knew we had the protection in place and it allows us to be on the front foot. And that was a really powerful and very useful tool for us and for our investors because it meant that they had a significantly smoother ride through times like this where markets are very volatile and there's lots of uncertainty, and it means that their asset values just hold up significantly better than they otherwise would. So what are the benefits of this additional toolbox? I think the main thing is to say that by having this variety of tools, as a manager, it means that we can do two things. One, so we can protect the downside. We can make sure that your portfolio with us is held up really well in times of market uncertainty and produces really low volatility for you as an investor and for your clients, which is super important. And then the second thing is that it brings the correlation of our portfolios right down. So what that means is that our funds are going to behave very differently to many of the long-only products you will already invest in. And that adds value to an investor through the cycle because it means that we'll be firing on all cylinders when they might not be. And so again, I think the takeaway really is if the toolbox is used correctly and if it's used by a manager who knows what they're doing, it can produce a really, really consistent return profile. That's not dependent on stock markets going up or funds doing, markets doing particularly well, but more about producing consistency and stability for an overall investor's portfolio. So in summary, I think the larger toolbox really is that as hedge fund managers, we have the ability to take short positions. We have the ability to use pair trades. We have the ability to do rump trades. We have the ability to utilize derivative structures. And all of those, hopefully, are used by the manager to produce better risk-adjusted returns than they otherwise would be able to give you in a long-only product. Thanks for listening.